This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you in part by
TheStreet.com, featuring Stephanie Link, who shares her investment strategies, stock picks, and market insights with Action Alerts Plus, the multi-million-dollar portfolio she manages with Jim Cramer. You can learn more at TheStreet.com/NBR.
Diving into October, that's what stocks did today, and it was the worst start to the quarter in 3 years. Tonight, we begin a two-day look at what's next for domestic and global stocks, bonds, and commodities.
Fast lane. Consumers drove off with more cars in September than they did a year ago. And there's one automaker that's suddenly hot with car buyers.
And economic contagion, the fallout when a potential health crisis causes the fear factor to ramp up. We have all that and more tonight on Nightly Business Report for Wednesday, October 1st.
Well, good evening, everyone, and welcome. The market's kicking off the month of October and the final quarter of the year with a massive sell-off today, sparked by worries mostly about global growth. Not helping? Some disappointing economic data out today showing a slowdown in U.S. manufacturing in September and a drop in construction spending in August. Not even good news about private sector hiring. And some strong auto sales last month could blunt today's big declines. The major averages are now at their lowest levels since mid-August, and the small cap Russell 2000 index officially dipped into correction territory, down 10% from its July 3rd high. Here's a look at the damage at the closing bell. The blue chip Dow stocks off 238 points, just off the lows of the session, but closing well below the 17,000 mark. The Nasdaq lower by 71, and the S&P 500 lost 26 points. Utilities, the only sector in the green today. With the new quarter off to a dismal start, what do traders and investors have on their agenda that will drive the markets for the rest of the year? Dominic Chu takes a look.
The fourth quarter is finally upon us. It's a period of the year that many experts think is a more positive one for stocks. But this time around, investors will be tuned in to a number of different items on the market agenda. First of all, there's the economic data, which has painted a more mixed picture as of late. Some of the most important data over the course of the next 3 months will be on the jobs front, as well as consumer spending as we head towards that all-important holiday shopping season. Second, we're getting ready to kick off yet another big earnings season. Many investors are looking for a reason to justify the stock market that still hovers near record highs. Growth in corporate earnings and sales could go a long way in setting the tone for the next few months. And third, the impact of the Fed is still a huge variable. Our nation's central bank has been slowly reducing the amount of stimulus in the system, and some experts say that there's no telling how markets will react to the so-called Fed taper. After all, we've never seen anything like the Fed stimulus program in the past, or what happens when you try to unwind it. Now, when it comes to where traders want to see strength in the stock market, many say look towards the banks.
I'd like to see some stuff come a little bit better out of the financials, both in their activity. I'd like to see bank lending pick up. There's some feeling that some of the regulatory safeguards that have been put in are sand in the wheels. I think if the financials picked up, I would feel a little bit better about it.
Let's not also forget we've got what could be a huge shift in the political landscape in America, with midterm elections just a little over a month away. All of these things could be potential catalysts for the overall market, so investors are going to want to stay vigilant. For Nightly Business Report, I'm Dominic Chu from the New York Stock Exchange.
So where do the markets go from here? We begin a two-part discussion on the outlook for U.S. and international markets, as well as the forecast for bonds and commodities. Our guests tonight look at U.S. versus international investing. Paul Christopher is the Chief International Investment Strategist with Wells Fargo Advisors, and Seth Masters is Chief Investment Officer at Bernstein Global Wealth Management. Welcome very much, gentlemen, for joining us. Seth, let me begin with you and the U.S. markets. Why did we get this big sell-off today? Is this the beginning of that correction that everybody's been talking about?
Quite frankly, I don't know. But I think that over time, what we're going to see is that the market will continue to trend upward with a fair amount of volatility because the underlying fundamentals continue to be good. The economy is growing, and companies are earning really at very strong levels, and we think in a way that it's pretty sustainable for the next few years.
All right, Paul, let's turn to the international outlook. Do you like the international markets more than you like U.S. markets? Which do you think will perform better over the next 12 months?
No, we would be with Seth on this one. We'll take the U.S. this time, where we're overweight U.S. large caps at this particular time. We think the trend will be higher over time, but we do think that maybe international is getting a little bit too pessimistic in terms of the outlook investors have. I think Europe's recovery has turned a corner. It's going to be slow. It was always going to be slow, and we'll see some improvement, marginal improvement next year. And I would look for opportunities to buy into undervalued stocks at that time.
You know, Paul, when we talk international, I mean, it covers so many geographies. Can you be a little more specific? I mean, Europe versus China versus, let's say, Brazil, which stock market was down 2% today. Any specific ones to invest in and what countries to avoid?
Right. Well, a couple of basic rules. First of all, we like the European recovery to improve from here, and we think there's been too much pessimism. So that said, we would take a core approach to Europe. We like Germany, we like Switzerland, we like the UK. That gives us a little bit of currency diversification as well. In terms of emerging markets, the second rule would be go with countries that have demonstrated a willingness and an ability to do economic structural reforms. In the good camp there, we'd put Mexico, we'd put Taiwan, Korea, we would put China, but we would put in the underperformers, the underachievers, Brazil, and we would also put Indonesia and Turkey in that group.
You know, Seth, I guess I hear you saying that the bull market thesis is intact, but you don't rule out the possibility of a correction. When interest rates start to move up, as inevitably they will, who knows and who really cares whether it's March or June or next August, will that automatically mean the death knell for the bull market?
Great question. And we think there is actually on that a fairly logical answer, which is that while there may be short-term jitters when the Fed begins to lift off from the zero interest rates it's had in place for the last few years, it's actually probably going to be a good thing for stocks over time. And the reason why is when interest rates are rising, especially from very low levels, as would be the case next year, the reason is that the economy is improving, which means that companies are actually growing, and that generally is good for stockholders.
All right, so let me ask you, Paul, what you think of what Seth just said. So the Fed ends its stimulus program. That might be good for U.S. stocks, but is that good or bad for some of the international markets?
It's initially going to be a headwind for international markets insofar as the dollar should continue to stay strong, and that will put foreign currencies under pressure. So if you're a U.S. investor, you want that foreign position that you're holding to have an appreciating currency, not a depreciating one. But I think what's eventually going to happen is what typically does happen, and that is the U.S. will pull foreign growth higher, and the currency depreciations overseas will end up benefiting exporters in those countries and boost their earnings as well. We could even find that international markets will give investors a boost in their portfolios, even as maybe the S&P eventually gets to its top.
Seth, 30 seconds here. Why have small company shares sold off so much more than large company shares, and is a point of opportunity near?
I think that the reason is that people really don't like volatility at the moment. They've gotten used to very complacent low levels of volatility, and when you look at small cap stocks, the first thing you think about is that they are riskier. The other point is that small caps were quite expensive when they were at their peaks in March of this year. They were trading at around 20 times earnings. Today they're back to something more like 18. That's closer to the broad market. I think that means we're probably closer to the point where things will move together as opposed to quite as big a difference between small and large as we've seen recently.
Paul and Seth, thank you so much. Paul Christopher with Wells Fargo Advisors and Seth Masters at Bernstein Global Wealth Management. And tomorrow we'll take a close look at bonds and commodities and what's ahead for those markets over the next few months. Tyler?
More now on that solid jobs data from the payroll firm ADP for last month. Private employers added 213,000 workers in September, a bit more than forecast, with gains seen across a number of sectors. Now, the ADP report is a forerunner and sometimes, but not always, a predictor of the Labor Department's official jobs tally. That one comes out on Friday.
Despite today's market slide, the head of the world's biggest hedge fund has an upbeat outlook on the U.S. economy. Ray Dalio, the founder of investment firm Bridgewater Associates, says the economy and current market conditions are actually in good shape.
The conditions are good, corporate-wise, balance sheets, everything-wise. that should continue to have that kind of a momentum. I see no real reason for a problem in the United States now other than too tight a monetary policy, and I don't think you'll go to too tight a monetary policy.
Dalio did say that he is concerned about another possible downturn, but says that's at least 18 months away.
The CEO of General Motors also sounding confident about the future. Mary Barra told investors at a meeting that she expects GM to reap its first profits in Europe in more than a decade in 2016. And she predicts the automaker will hit North American operating margin targets that same year. GM also plans to increase production over in China and give money back to shareholders.
From a shareholder return perspective, as we deliver results, our plan is to continue to return excess cash flow to stockholders, primarily through strong and growing dividends, that will be based on our performance and not only the performance year to year, but the underlying strength of the balance sheet.
Investors like what they heard. Shares of GM up nearly 2% on a very down day in the markets overall.
Well, General Motors was one of the big winners in the September sweepstakes for auto sales. September was also a profitable month for the entire industry. Sales were up 9% from the same month last year, with an annual selling pace of nearly 16.5 million vehicles. Sales at both GM and Chrysler jumped 19% year over year. Ford sales were down almost 3%, but that drop was better than forecast. Phil LeBeau joins us now from Chicago with more on those strong numbers. Phil, no question about it. September numbers, very impressive. But is it because of incentives? Is that how dealers are closing out deals? And is that good or bad?
Well, incentives were up just a little bit, Susie. I wouldn't call this one of those months where you drove by a dealership and there were signs saying, come on in, you're going to get $6,000 to buy a new car. We didn't see that. We did see a little bit of juice, as they say, spread on some of those models that are struggling a little bit. But overall, the incentive activity was generally kept in check.
What are lower gas prices meaning for the sales of bigger cars, SUVs, trucks like the F-150 you showed us last night?
Right. Oh, you're seeing more people buy the full-size SUVs. There's no doubt about that. Here's the bottom line when it comes to gas prices. When they spike higher, people immediately pull back. When they come down, it takes a while for people to realize, hey, you know what, I can get a little bit more with this SUV, and therefore I'm not going to feel it in the wallet when I go to the gas pump. Also, remember, all of these SUVs, guys, they're far more fuel efficient than they used to be.
Phil, tell us about Chrysler. It sold more vehicles last month than Toyota, up 19%. Why is it so hot right now?
Well, they're in the sweet spot of the market with two of their brands. Jeep, because SUVs are so hot right now, and Ram trucks, because pickups are in demand. And also, their lineup, when you look at the Ram trucks, especially with the Eco Diesel option, or when you look at the Jeep lineup, which is fresh across the board, I mean, they're selling right now because they have fresh product. And that's the bottom line in the industry.
Okay, thanks, Phil. Phil LeBeau reporting from Chicago.
And still ahead, PIMCO tells investors just how much money fled from its flagship Total Return Fund after founder Bill Gross walked out the door.
More evidence today of how much the sudden resignation of bond king Bill Gross from PIMCO shook up the fixed income market. Today, PIMCO released data for September. Outflows for the month at the firm's signature total return fund were nearly $24 billion. That is huge. The largest withdrawal was on Friday alone, the day that Gross resigned.
The market plunge today isn't the only worry on the minds of investors after officials in Texas confirmed the first case of the Ebola virus diagnosed here in the U.S. So could the fear factor surrounding Ebola hurt the U.S. economy? Steve Leisman takes a look.
We do not believe there's any risk to anyone who was on the flight at that time.
Health officials may say that, but it didn't stop Wall Street today from selling off airline stocks. One index plunged by almost 3% on fears of reduced airline traffic after the announcement of the first Ebola case in the United States.
Given the recent developments of what's happening with the Ebola disease that's now hitting the shores of North America, people are getting obviously concerned about air travel. And investment specialists are trying to get ahead of that trade a little bit and starting to dump out of the airline stocks, thinking that the business may be down. We're going to be watching that. We're also going to be watching other stocks that may be impacted by this. The hospitality industry, for example, they could be impacted as well until the situation clears up.
Health officials insist they can contain the virus in the United States, but the impact on airlines is just one potential fear running through the minds of investors. One study estimated the SARS virus back in 2003 cost the global economy $40 billion. Retail sales in Hong Kong plunged 15% in just a single month at the height of the crisis. Airline travel to Hong Kong fell 77%. Assuming, as many experts do, an outbreak never happens in the U.S. or is contained, the broader impact could come if officials must respond to public fears and restrict travel, or if people voluntarily decide that it's just safer to stay home. But all of that pales against the far deeper and more painful impact in the Western African nations suffering from the Ebola outbreak. Beyond the horrific cost in lives, they pay a dear price in declines in growth, trade, and transit, making it even harder for them to respond with the financial resources needed to fight the deadly disease. The differing responses in the U.S. and in Western African nations highlights the biggest economic issue of all, one the world will be dealing with for decades, and that's the economic inequality that enables a wealthy country to potentially escape the effects of a deadly disease and a poor one to suffer the worst possible misery the virus can mete out. For Nightly Business Report, I'm Steve Leisman.
JP Morgan Chase is facing a big lawsuit. A federal judge has certified a class action lawsuit by investors who claim JP Morgan misled them about the quality and risk of $10 billion of mortgage-backed securities it sold just ahead of the financial crisis. This comes a year after the bank reached a $13 billion settlement with the U.S. government and several states over the same allegations.
And a judge throws out a Fannie Mae and Freddie Mac-related lawsuit against the government, and that is where we begin tonight's Market Focus. A group of investors in Fannie and Freddie sought to stop the government from seizing most of the profits at the mortgage companies. The hedge funds, the plaintiffs here, had argued that they had been shortchanged as Fannie and Freddie returned to profitability. Mortgage giants saw their shares surge more than 2 years on that speculation that shareholder rights to those earnings could be restored. Well, tell it to the judge. Shares of Fannie and Freddie both down more than 35% today. Coke, bowing to pressure from Warren Buffett, announced plans to scale back its executive compensation plan before that plan was to go into effect next year. Shareholders have continued to criticize the beverage giant, saying the awards were excessive. The company says the new plan will limit its stock compensation and improve transparency. Coke bubbled up a little bit to $42.74. And the New York Times is cutting 100 newsroom jobs and a smaller number of other positions to slash costs. This comes as its advertising revenue from its print business has shrunk and as it tries to focus more of its resources on digital operations. Shares of the old gray lady up 9.5% at $12.30.
Vivint Solar made its trading debut on the New York Stock Exchange today. The company is the second biggest installer of solar panels for residences in the U.S. It raised about $330 million after pricing its shares at $16 apiece. The CEO says there's enormous potential for the solar panel industry.
Right now, we're saving customers 15 to 30% on their utility rate that's generated by fossil fuels. If you look historically in the 7 states where we're at, the average utility increase is 6%. And so given the fact that the utility rates historically have continued to rise, nationally 4%, we think that there's a huge opportunity to provide clean power at a lower price.
Shares closed just a penny higher at $16.01. Shares of Angie's List jumped on reports that the company is exploring a sale. The online review site has hired bankers to search for strategic options, but it's not committed to a definite sale, according to those reports. Shares surged 19% to $7.59. And satellite TV provider DirecTV reached a new multi-year contract with the NFL. It'll be able to continue to sell its Sunday ticket packages of NFL games, and the agreement has expanded its rights to stream games on live mobile phones and over the internet. Shares spiked initially after hours. During the regular trading day, the stock was up just a little at $86.59.
Well, with cybersecurity so important these days, just how difficult is it to recruit top technology employees? especially when you're the NSA and competing against the likes of Google and Facebook for some of the same individuals. Pretty tough. Eamon Javers has the story.
Rocked by the Edward Snowden disclosures and facing stiff competition for top talent from high-paying Silicon Valley firms, the nation's cyber spying agency is looking to recruit a new generation of college hackers, and through one new program, cultivating students as young as the 8th grade. 32-year NSA veteran Stephen LaFountain is building a pipeline of NSA employees by developing a cyber curriculum for tech-savvy students at more than 20 universities, and helping with NSA-backed summer camps for middle and high school students. LaFountain sat down with us at the NSA's History Museum, where he told me the NSA works hard to lure top talent.
Clearly, we lose a lot of incredibly talented people to Google and Facebook and Microsoft and all these other places, but we also get a lot of very, very smart people as well, because some people just have this motivation to do what they think is right, to work for the government.
And LaFountain insists the students he's bringing to the spy agency simply aren't bothered by the Edward Snowden disclosures.
Actually, I don't think it's been damaging to our ability to recruit talent, in that many of the students that I talk to, anyway, that I interact with, they're interested in the tech, right? They're not, bothered by, let's say, the politics of things like that. They're interested in the technology.
LaFountain said that new NSA employees need to know that even though they're trained to steal foreign data when they're at work, they can't hack when they're off duty.
So you can't go out and do that in your personal life, right? You can't do that against family, against friends, against neighbors. You gotta be still a model citizen in cyberspace.
Eamon Javers for Nightly Business Report.
And coming up, the big business that's being done behind bars and whether it's right to profit from prisoners.
The now closed down Revel Casino Hotel in Atlantic City, New Jersey, has a new owner tonight. Canada's Brookfield Asset Management, which already owns the Hard Rock Casino in Las Vegas, was the highest bidder in a bankruptcy auction for the Revel, topping rivals with an offer of $110 million. Now get this, the 2-year-old casino, which shut its doors last month, cost nearly $2.5 billion to build.
The United States is home to 25% of the world's prisoners, and the prison market has become quite lucrative for some companies. CNBC, which produces this program, and through a joint partnership with the Center for Public Integrity, took a look at the big money behind bars. Dina Kosofsky reports.
The United States has the highest incarceration rate in the world. Over 2 million people behind bars, which provides ample opportunity for some to be on the front lines of profiting from prisons.
Thank you for calling JK. Have a good day.
Ryan Shapiro is one of those people. He runs a company called JPay that took in about $50 million in revenue last year from a captive, literally, market. The bulk of the business is providing electronic money transfers for corrections facilities.
The pitch is that this is more convenient for you.
Loved ones can put money into an inmate's account without ever leaving the house. Each time a family member transfers the money, JPay charges a fee, ranging from about $1.45 to $24.95 per transfer. Once inmates get that money via JPay kiosks set up in the prisons, they can then use it to buy other services that JPay also provides, like email and video visitation, $12.95 per 30-minute session. Even tablets for inmates, like this JP4.
How much did that cost you?
It was $59.99.
The tablet holds music that inmates can download from yet another JPay service, similar to iTunes. But it's not just JPay that's profiting. The company operates in over 1,200 facilities in 32 states, and there's a profit-sharing agreement with each state.
Government agencies can and will accept a portion of the revenue as an incentive to put the program in.
But those like Jack Donson, who worked at the Federal Bureau of Prisons for decades, has a problem with anyone making money on the backs of prisoners.
I felt more the government bureaucracies who are profiting from this as well. The sentence is the punishment. Inmates are not put in prison to be punished. They're put in prison as punishment.
Keith Miller is doing 21 and a half years for armed robbery in a prison in Bland, Virginia.
It's not right that, my family has to pay for money to be sent to me.
Critics argue this leads to gouging, and investigators and regulators have already gone after some companies, especially those that provide phone services for prisoners, like Paytel.
And the reason we're in this mess now, on my side, my industry has abused the public. And I'm willing to admit that. We have abused the public.
The FCC had to step in and cap rates for prison phone calls. But JPay CEO Ryan Shapiro says that regardless of the flaws in the system, he's providing valuable services to those behind bars.
Before JPay came around, that type of customer service did not exist in corrections, period. It's unfortunate nobody's come out with a better model. And if somebody did, that would be fantastic, but nobody has yet.
For Nightly Business Report in Bismarck, North Dakota, I'm Dina Gosofsky.
And that is Nightly Business Report for tonight. I'm Susie Garob. Thanks for joining us.
And I'm Tyler Mathisen. Thanks from me as well. Have a great evening, everybody. We'll hope to see you right back here tomorrow night.
Nightly Business Report has been brought to you in part by
TheStreet.com, featuring Stephanie Link, who shares her investment strategies, stock picks, and market insights with Action Alerts Plus, the multi-million-dollar portfolio she manages with Jim Cramer. You can learn more at TheStreet.com/NBR.
I'm Susie Garob with the Nightly Business Report news brief. Wall Street kicked off October and the final quarter of the year with a massive sell-off. Investors sold stocks on worries about global growth and concerns about new reports on the U.S. economy, a slowdown in manufacturing, a drop in construction spending. Not even good news about a big jump in private sector hiring could help. The major averages are now at their lowest levels since August, with the small-cap Russell 2000 index falling into correction territory, down 10% from its July high. Here's a look at the damage at the closing bell. The Dow tumbled 238 points, the Nasdaq lost 71, and the S&P down 26 points. But auto sales were strong last month. Sales at Chrysler and GM, both up 19%. Be sure to tune into Nightly Business Report right here on your public television station.